Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for October 19th, 2020. Please see our disclaimer for important information. In our chart pack this week, as we always do during this pandemic, we start off with our covidtracking.com piece. And in particular, we're monitoring the 7-day moving averages in both daily new positives as well as daily deaths. And so you can see in the blue that daily new positives are continuing to trend up. And this is not just a reopening of school type phenomenon. Clearly, there's more at work here. The good news is that we don't see that daily new deaths tracking in the same vein, but you do see them kind of leveling off. So they're not decreasing per se as they have over the last couple of months. But obviously, we're going to continue to monitor that. Now, looking at it regionally, you can see that all areas are trending up to some degree. But in the Midwest, there's been a particular rash of daily new positives. And I think it would be, we would all be hard pressed to say that, this is just a rash of new outbreaks versus testing. There's clearly more testing going on. But I think to see that kind of deviation for the Midwest relative to the rest of the average, I think what it speaks to is the fact that you've got more rural transmissions where we really didn't see that before. We saw most of the major outbreaks in the major urban areas. Here's our high frequency data for the week. You can see some parts of the economy such as air travel is doing well, hospitality is doing well. Our TSA checkpoint data was up 12% over the last week and up 16.5% over the trailing month. And we'll have a chart that follows this up that kind of highlights that. Hospitality is doing a little bit better. Daily rates are down over the month, but all the data related to hospitality is up over the last week. And restaurants are down. Obviously, we've had some with the rise in positive cases, we've seen some closures and some jurisdictions clamping down, like say in New York. We've had areas, certain boroughs that are actually almost literally going into essential services kind of lockdown mode. So that's obviously had an adverse impact on the restaurant industry. Box office receipts for movie theaters are down certainly over the last month, but we really haven't had any new productions come through the theater, so there's really not an incentive for people to go. And you'll see kind of in an upcoming slide just kind of the fact that people are less inclined to go to a movie theater until things are really resolved with regard to the virus. Rail car traffic, everything tied to manufacturing is doing really well. Steel production, we've had some real good data there. Rail car traffic, which is kind of almost what they call intermodal. It happens to, either raw material transmissions or rail car with intermodal and container cartridges, which are in many respects retail type products that are going to and from. That data is looking really good. From a staffing perspective, initial jobless claims were a little bit higher last week than we're not getting really good really good data out of initial jobless claims. Now, that's not to say that labor is going in the other direction, but it's just not improving like it has in the past. Now, on a positive note, continuing claims continue to do well. So those are the longer term, the more systemic displacements that are trending a little bit better lately. It's just that initial claims are kind of stuck in that high 800,000 a week range, and we'll certainly want to see that come down. But I think as you'll see coming up, the state of the small business sector, that's going to be really tough, and it's going to take us a while to get through that. Here's our chart on the TSA checkpoint data. You can see in kind of the solid blue, the 2020 line. And, obviously, we had a huge displacement, almost down to zero, literally a 99% decline in traffic for a while. And that continues to pick up We had a little bit of a stalling out in July. We were a little worried at that point. Obviously, we had a rise in case volume, which we do now, but we're seeing perhaps a little bit more travel that may not necessarily be tied just to personal travel. Now, it's going to take us a long, long while to get back up to that gray line that we saw last year, that being the trend line in 2019. And a lot of that delta there is business travel. And we know that that's going to take a while. We know that, like coming out of the global financial crisis in 2008, 2009, that literally took 18 to 24 months to kind of restabilize. And I think there's a lot of, folks that don't have that institutional memory, or, it's been so long ago that we tend to forget those things. But you can see in a good way, we're seeing more TSA checkpoint numbers, but it's just going to take us a while. Mobility, as you can see here, in these various components, whether it be transit, workplace, retail, recreation, we're still kind of below that pre-pandemic point. Now, grocery and pharmacy, those numbers actually were above their previous levels for a bit in June and July. They've kind of trailed off a little bit. Now, some of this data lags, so even though it's mid to late October here, some of these components we only have August data for. So, but as you can see, clearly from a retail and recreation standpoint, we're tracking below where we had been, and in particular workplaces in that light blue, and that's probably the line that's going to take the longest to find its way up, and it's going to be a function of kind of this new normal once the pandemic has passed, and just the global appetite that people are going to have on wanting to go back to the workplace. And a lot of employers are saying, listen, a certain percentage of our workers can stay at home, and some people are saying we don't need to even come back to the workplace. So I think that number, one, is going to be harder to track because people are just going to be so mobile and displaced. But also, it's going to take a while to get back. And transit station, I think that goes to the prior slide and the TSA checkpoint. You're just simply going to see that number kind of waffle for a bit until people are comfortable in getting out again. Here's our slide from Civic Science that I referenced earlier, and it just goes to show you that some of the sectors of our economy are just going to take a while to get back. And it's really going to be a function of how soon we're able to get mass inoculations from a vaccine, or, we get to this herd immunity, which, even if you assume that we've got 10 to perhaps 15% of the population that may have had COVID, some people don't know it, but, herd immunity is, widely acknowledged to be 60 to 70%, and we're nowhere close to that. So this is just a sentiment indicator. And I've shown you several iterations of this over the last handful of months, and this just happens to be the latest one based on census data, but run by Civic Science from October 7th through the 13th. And you can see the responses for each of these categories. So in my opinion, it's a reasonable sample size of respondents. I think it has reasonable predictive power to it. Even though it's in the in the thousands and not necessarily in the 20, 30, 40,000 category, but it's helpful. So going back to work, I think the majority are comfortable in going back to work, whatever that means. Shopping in stores, which are non-grocery, you have more people that are interested in getting back into stores, perhaps. This is a weekly reading that they do, and so this number was down over the last week, but you can still see that basically almost a quarter of the population is not going to be ready to go back into non-grocery retail stores for at least 6 months. Eating out at restaurants, that number is a little bit higher. Half the population's okay with doing that now, even with capacity restrictions and things like that. And then you've got if you add those two together, you got 30 and 20. You've got half the population that is not willing to go in there for at least another 2 months. So already we're talking about 2021 here. and then going on vacation, that's pretty intuitive, attending a large public event, and going to a movie theater, which is what I mentioned before with the box office receipts being really out of whack. That you see an overwhelming majority of folks that are not comfortable in going to a movie theater for at least 6 months. And these are not huge individually components of the economy, but collectively, I think what this points to is that 2021 is going to carry some of this baggage, and it's going to retain some of the water that we've taken on here in 2020. So the notion that 2021, January 1, it's going to be Pollyanna, I think is a little bit far-fetched at this point based on this sentiment data. Again, it's going to be imperative on what consumers actually do versus what they say they're going to do. And sometimes those kind of deviate a little bit, but right now the sentiment is fairly mixed when it comes to overall retail and spending activity. This is our economy in a nutshell. As you look at a quarterly data, and you can track it, from left to right, you can see the dip that we had during the global financial crisis, and that was obviously not insignificant for anybody that was around at that time that was paying attention. I mean, that did not feel good, but even still, that was less than a 10% GDP annualized drop in any one particular quarter, and then. But we know when, looking through this data that, we've seen this major 30+% dislocation. And we're going to get this data for third quarter, at least the first round of this, and it'll be revised twice before it's finalized. But what we're going to see is a huge jump. I think there's fairly strong consensus in that regard because it's really hard to not have a jump after you've had the drop that we've had, which is that line. So everything in the shaded orange is a projection looking ahead. And so, what we get is a kind of a fairly meaningful bounce back on the third quarter, but then it tempers out. And I think the real question is how much it tempers out. And I do think that we're going to remain positive in terms of our quarterly annualized growth rates, but it may be consistently less than 5, which if you look at the 30+% drop and you look at maybe a 20 to 30% gain off of that drop, it just tells you it's going to take us a while. It's going to take us several quarters to kind of battle back and gain back everything that we've lost. So we'll watch for that report, and obviously we'll have an analysis of that in our upcoming conversations. This is a snapshot of our payroll employment, and it's reflective of the drop from the beginning of the year. You can see that we were pacing in a very fairly meaningful, positive upslope way, getting more people involved in the workforce. Obviously, unemployment was historic low, something we haven't seen in multiple generations, and then that all changed course, of course, in April, and we battled back, but we still have perhaps 142 million in the labor force when we've had over 152. So you think about the 22 million jobs that were lost, and a lot of those were low income, low wage. We talk about this in our market minutes sometimes when we kind of review some of the impacts to labor. It's obviously hit the lower socioeconomic bands a lot harder. I mean, the people that are not white collar, that could easily go home and do the same thing that they're doing inside a high-rise office building. These are the restaurant workers and so on and so forth that have been adversely impacted. And we're still 10 million short in the in getting those jobs recovered. And kind of as a follow-on to that, so this is really as much of a function of the problems or the plight of the small business sector as it is anything else. And so obviously we're 10 million jobs shy of where we were prior to the pandemic. But as you can see in this chart, and this is from the Bureau of Labor Statistics, but several of these charts were lifted from an FS Investment presentation that I took part in. You can see that orange part of that bar that represents permanent job losses, and those continue to rise. And this really is, I think, as much due to kind of the shock of what happened in April and May and not getting those jobs back. And so it doesn't really have as much to do with maybe a July rise in coronavirus cases or maybe the more recent uptick in coronavirus cases as it does with just the fact that there was so much shutdown and there's not as much reopening. And this is all really kind of saddled within the small business sector. Now, we've talked about spending a little bit, and we know that goods spending has certainly picked up, and that relates to everything that you might imagine that you could buy through Amazon, you could buy through the grocery store. Obviously, there's been a lot of durable good things that people have bought, boats and things like that during the pandemic. So goods spending has really recovered and it really recovered beyond where we were. Now that's offset the lackluster services spending, which is somewhat intuitive if you assume that there's still a lot of businesses that are not operating, or to the prior slide, there's been permanent losses of and permanent closures of businesses. So we haven't had that pickup in service spending that we knew was going to take a while anyway, but it's clearly tracking fairly anemically. So we're at least, probably on balance about 7.5% below where we were in January, certainly. And then you can see the pie chart on the right, which just kind of gives you the dependency. So obviously services represents, 4/10 of all spending. And so it's not insignificant. So there's 4/10 of the economy that's really dragging in terms of spending. And so this is what we're going to have to watch out for if we continue to see that bump in permanent business closures, permanent job losses, purchasing power for, people that are employed by businesses goes down, the more people that are displaced, either permanently or temporarily. And so we're just going to have to watch this. This could have implications on 2021. A little bit too early to kind of gauge what that impact might be. Business sentiment indicators are clearly much better. So if you kind of divest yourself of the perspective of the individual and look at it through the eyes of businesses, now you can see both manufacturing and non-manufacturing, which represents a much greater percentage of the economy than manufacturing. Both of those indicators are trending up. Now, these are really positive signs because these are purchasing managers. ISM stands for the Institute for Supply Management. This is data as of as of September. So we get this data on a monthly basis. So this chart does not have the October data yet in it from Macrobon. But good news is that business owners, business operators feel a little bit better about the economy. Here's what I was talking about on small businesses. So in both cases, if you look at the top, it represents revenue. Bottom, it represents small businesses open. Both of those, as of the end of last month, are tracking 20 to 25% below. And this gives you the timelines, and you can look for yourself to see that revenue and business openings or business closures rather track very similarly. And we've had a little bit of recovery, but we're still tracking again on small business, not overall. So I mean, small business, if you think accounts for the majority of employment, accounts for the majority of businesses out there, we're still about 20 to 25% below where we were. And in a very similar way, we're down on revenue too. So this has implications for business spending. It has, for hiring and employment. And a lot of this data correlates very well to the number of permanent job losses and whatnot. So obviously troubling to see this. This is something that we absolutely have to keep our finger on top of, and probably doesn't get as much press as it probably should because of all of the press and exposure that's given to the larger companies that trade within the S&P 500. Now, housing, on the other hand, is doing extremely well. Low interest rates, and if you have good credit and you are financeable, you are in a good place right now. And not only are we experiencing a kind of a surge in housing starts, but existing home sales, it really is a seller's market right now, and it's actually fairly extraordinary when you think about this data. That you've seen so much housing mobility at a time where we've had a lot of disruption in the labor market, which you know you might think intuitively if people are out of work, they're not inclined to move, uh, to change residences. But at the same time, I think we've seen a little bit of improved mobility that people are willing to pick up their tent stakes and go to where the jobs are for the people that are able to get jobs. And but in a lot of cases, people are simply doing refinancings of existing homes that would not be reflected in this number, but you see it in the mortgage data. This slide kind of brings us current with where we stand on government deficits and state and local spending. And as you look at the contribution from state and local spending on the right, you can see that it's really gone down. We've actually seen, at least a couple million jobs lost in state and local government levels, people being laid off. Civil service has dropped somewhat pronounced, and that's one thing that's going to take a while to get back. That we're going to see challenges on tax bases across many jurisdictions, and so people are preemptively laying people off in anticipation of having lower revenue for their municipal finance budgets. And so that's a multi-year phenomenon. So you can see that the state and local contribution of spending, or basically a contribution of our GDP, has gone down, and it's likely to remain fairly subdued. At the same time, our deficit on the left has really gone through the roof as a percent of GDP, and I think it's clear that under any scenario, whether it's a Trump presidency or Biden, whether or not you think that there's going to be a blue wave or a split vote where Trump wins and perhaps loses the Senate, or any of those scenarios, I think you're going to continue to see spending. There's going to be a really strong appetite for more stimulus at some point, and certainly into next year. This chart I thought was really interesting because what it does is it takes the inversion in that gray line of coronavirus cases, and it plots it against this Trump polling data less Biden's polling data, and you can see that if you look at that real clear politics poll, basically Trump minus Biden. Right now that Biden's got roughly a 10% polling advantage over Trump. But interestingly enough, I don't know that I draw too much predictive power out of this, other than to say that it was interesting to me when I saw this that there is a fairly strong positive correlation to Trump's polling relative to coronavirus, and that would seem relatively intuitive. But I just thought it was interesting to present to you all here. Not to get into the weeds too much on Biden's policies, but this was from Penn Wharton at the Wharton School at Penn. Their model just shows you kind of what Biden would spend money on ideally if he were elected, and how would he pay for it. So in the gray bars that represent spending. So if you're looking at roughly $2 trillion in education, you've got about $1.5 trillion in infrastructure. You've got perhaps a little less than $1 trillion in housing, and then you also have paid leave and healthcare spending with a little bit of a Social Security escalator. But to pay for that, it's going to raise about $1.5 trillion from corporate tax increases from 21% to 28%. At least that's what he's talking about. Increasing the payroll tax for high wage earners, leaving a donut hole in the middle, but getting those people that have relatively high incomes, as well as perhaps raising the individual income tax. But even still, that's not going to close the gap on the spending. There's still going to be about a $2 trillion excess deficit under this analysis. Election is definitely on the radar, and as the title shows you, what this represents is just economic policy uncertainty. Even though it's come down, it's still elevated. And what that's done is it's driven the volatility index higher. So what does that mean? That policy uncertainty is still high, and it's going to remain high for a little bit, regardless of how the election goes, and especially if it takes us a while to learn who the next president is going to be. But typically, you see some volatility in advance of the election, and you certainly see some volatility after the election. So I think in both of those cases, we should expect a little bit more volatility coming up. We'll get into interest rates and inflation for a few minutes here. This is the Federal Reserve's new framework, and I thought I didn't do the attribution here, but it's basically from FS Investments, and this is what I was talking about back in August when we had the Federal Reserve Bank of Kansas City's Jackson Hole Summit, and they did a pivot. They said, okay, we are going to target inflation that averages 2% over time, as opposed to targeting it at 2%. And they've not done a good job at that, because inflation's been tracking lower than that. And then they've also said that they're going to eliminate shortfalls from full employment. And so instead of just saying we want to minimize the tracking error here, so what they're going to do is they're basically going to let the economy run hot for longer, and really they've only got in the 10-year Treasury, they only have 0.7% to play with before that rate goes negative, and so there's really no policy maneuvering room available to the Fed right now. And so what they're going to do is essentially leave these short-term rates as close to zero as possible for a number of years, while that average hopefully takes hold over time. But right now it's clearly tracking below that. Change in the yield curve. I think what you can see here is that in that gold line, just how compressed that yield curve is. You see short-term rates are basically zero, but as you look at the kind of the solid white bar, they were 1.5%, at the end of last year. And in fact, at the end of 2018, the short-term rate, 1-month Treasury bill was 2.5%. And so it just goes to show you how far we've come, and that the major shift down, the yield curve is really roughly about as steep as it was at the end of last year, but you can just see how compressed it's become. This is a chart of expectations for Fed funds as well as inflation. So as you can see in the orange bar, that long run expectation line for Fed funds, or in other words, short-term interest rates, remains very close to zero. And that really hasn't moved that much. Long-term inflation expectations have eked up a little bit with this added stimulus. We had a shock to the system when the pandemic shut the economy down. And ever since then, we've had all of this massive injection of liquidity that's added to this long-term inflation expectation. But as you can see, we're still not up to that 2% that the Fed really wants to target. And frankly, this new pivot by the Fed, would imply that, based on where inflation has been, that we'd almost need to see like 3 to 3.2% inflation before the Fed's going to get excited, because remember, they're trying to average 2%, not just reach it. This is another chart which really just kind of lays the groundwork, I think, to future inflation. But as you can see here, there's really been no meaningful transmission from M2, which is a money supply. So money supply as a percent of the economy has gone through the roof, and we all know that. The Fed has injected a lot of liquidity through its asset purchase program, so on and so forth. But that has not led to inflation, which is noted in that red dashed bar, which is a core PCE deflator, which is the personal consumption expenditures number. And so that obviously continues to be low, be below 2%, but we still have a lot of money supply, which I think will add the feedstock for future inflation. And this is a chart that plots the forward PE ratio on the left-hand side against the real yield, which is inverted on the right-hand side. You see that there's a really tight correlation here with the fact that when you have negative real yields, which is where we are now, you look at the right-hand side, I mean, where the negative 10-year real yield is about negative 1%. Right now, and that tends to correlate with a fairly high PE ratio. And this is it's intuitive, but really the logic behind it is that you have stocks which are really the best thing going. Even though stock valuations, may be high, they're going to be higher because you certainly can't go to bonds and expect to have purchasing power because you actually have a negative real yield. So, where else are you going to go to get that real yield? And right now, it's got to be stocks. So that's what this chart refers to. This is fixed income. So this is the Barclays Aggregate Index, and this is the premier fixed income index out there. It's the one that's most often quoted. It's a composite index that has a bunch of different things: corporate, high yield, treasury. But what you can see is that the duration, which is in that black bar, this is a measure of price risk. So the higher the duration, the higher the degree of volatility in this index. And you can see that it's continued to eke up ever since the global financial crisis, at the same time that the yield has gone down. So, we showed a little chart last week that the percentage of return in fixed income has really shifted over time. Now you're getting much more of your return from price appreciation than you do from actual interest income. And you can see that that is clearly not going to change for a while. You've got lower yields and you actually have higher price risk. And so, the oddity is that you could actually have fixed income if you're not careful, and this places a premium on selectivity within fixed income. You could actually have a case where fixed income can contribute to volatility of an equity portfolio as opposed to take away from it. So this is clearly going to be a trend that we're going to have to navigate over time. Well, that will do it for the financial, economic, and market slides. I wanted to end on this one. I spend a lot of time when I have the time to read data and research from the World Bank, the International Monetary Fund, World Economic Forum, et cetera. This data comes from the World Bank, and what I think it really underscores is just the massive global impact of the coronavirus pandemic. And we here in the States lament the impact to us in terms of small businesses, permanent job losses, and things like that. But this is a systemic issue across the globe. And we've not seen a dislocation like this in modern times. And it really stuck out to me that, Sub-Saharan Africa and South Asia, I mean, all these areas that have had a pronounced rise in number of people in extreme poverty, which I think could be defined as like less than a dollar and a half a day, perhaps. And there's so many implications that you could conjure up, so many second order impacts that will need to be addressed over the coming decade, because you just can't reverse this and at the drop of a dime. It's going to require lots of programs, lots of aid, lots of cooperation, lots of global response to this. But in the meantime, you've got, health issues. You certainly have economic issues. You have social unrest issues. And there's so many different things that are born out of this type of a problem here that will have to be monitored. And I suspect that we're going to be spending more time here over the next year or two or three talking about this. So that will do it today for Charts of the Week. Hope you've enjoyed this presentation. As always, from the information you see on your screen, reach out to us with your questions, comments, cares, and concerns, and we'd be glad to get back with you. Until then, be safe and have a great week.